Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news, of course, because the only man that brings the news each week is Nick Bendel. Hello, Nick. Welcome back.
Thank you so much, Owen. I always look forward to our weekly discussions.
And looking forward to hearing what's in the news this week with all things related to property and finance. But what's been happening in your week?
Well, I had the pleasure to get a lovely 5-star Google review. I own a business, Hunter and Scribe, which does content writing for finance and property professionals throughout Australia. And Hunter and Scribe received this lovely Google review from one of our accounting clients. My accounting firm have been using Hunter and Scribe's content writing service for quite a while now. They've got their finger on the pulse for issues relevant to our audience, from accounting and tax topics to business and employment. They make it easy for us to publish quality website content, which helps us impress potential clients and boosts our SEO.
Fantastic. Doing great work as usual, I see.
Well, very kind of you. And what have you and Leafield been up to over the past week?
Well, as I mentioned last week, I'm sure we had end of month running, so it was a busy day on that day, and as suspected, the month of January was an all-time record month for leasing of properties. So the number of properties that we'd leased, and so that was why we were so busy over the Christmas and January period. So that was all good. We're now dealing with everything else that comes along with it, but we're doing some changes in software this month. So busy in the business with that, and growing the team as we have been. So new staff coming on.
That does sound exciting. I remember hearing a line in business maybe a decade ago, which is you're either going forwards or you're going backwards. It's not possible just to stay still. And I can see that Leafield is definitely in the going forwards camp.
Yes, always good to stay green, otherwise you start to rot.
I like it. I like it a lot.
Yes. All right, Nick, what's in the news this week?
Well, we've got 3 stories to chat about. Our first one is house prices tipped to grow over the next 2 years. KPMG has forecast that house prices will grow in every capital city in both 2025 and 2026. House price growth for this year is expected to be Perth 4%, Canberra and Melbourne 3.5%, Sydney 3.3%, Brisbane 3.1%, Adelaide 2%, Hobart 1.8%, Darwin 1.2%. And house price growth for 2026 is expected to be Sydney 7.8%, Melbourne 6%, Brisbane 5.6%, Perth 4.6%, Adelaide 3.6%, Canberra 3.5%, Hobart 2.7%, and Darwin 2.5%. Owen, are you surprised by the prediction that house prices are expected to grow in every capital city in both this year and next year?
No, not really surprised. And it's not like they're going out on a limb to say that there's going to be huge growth in any one particular city. So it's fairly predictable growth. It's there's been some stagnation in some of the cities that have grown a lot in the last half a dozen years or so. So for them to start picking up and having a little bit of growth wouldn't be surprising. And for the ones that have been booming in the last year or two, then to see them start to slow down. And so it's just a leveling off all around the grounds, I would say. And especially with the expectation of interest rates dropping once or twice this year, then yes, we would expect to see a bit of an uptake in house prices. So yes, nothing too surprising or outlandish with their predictions.
And just following on from what you said a moment ago, that there's expected to be steady growth, but no particularly strong growth. Does it surprise you that not even one of the markets is tipped to boom?
We would, well, the economy is still teetering along of whether it's growing or not. Um, Inflation's coming down. Uh, then economic growth is still going. Yes, as we're still growing, but we're trying to halter it with interest rates, and then interest rates are starting to talk about coming down. So it's almost like we're all going to have a bet each way here because we're all not too sure what's going to happen.
Interestingly, Sydney prices have been going backwards for a few months, Melbourne prices for more than a year, but KPMG has forecast that Sydney and Melbourne are going to have the most house price growth over the 2 years combined. Does that sound realistic to you?
Yes, I wouldn't be, well, definitely wouldn't be surprised with Melbourne because they haven't had any significant growth for a very long time. They're the only capital city in the country that hasn't. And when they're half the price of Sydney in terms of median house prices, then yes, it just makes sense that they would get some growth. And Sydney, well, Sydney's going to be Sydney. It just can't be stopped. And with lack of housing and the demand for because of the jobs are here, then that's what's going to keep driving it.
That leads on very nicely to our second story. REIA unveils housing plan. Ahead of the federal election, the Real Estate Institute of Australia has unveiled what it calls a comprehensive election commitment plan to tackle Australia's ongoing housing challenges. The REIA has made a series of recommendations which include fast track the increase in new housing, in part by encouraging older people to downsize. Firstly, Owen, what do you think of that idea?
Yeah, that's a brilliant idea. It's one of the reasons why I've talked about having stamp duty reform, and it's so that we can allow or give incentive for older retirees to be able to sell their house and downsize, because you've got these empty nesters with not a lot of income living in big houses that they can't afford to upkeep. Uh, so it would be obvious for younger families with higher incomes, but with uh, lower wealth, um, be able to get into these bigger properties. So, they might have smaller deposits, uh, and but the retiree can sell the property. We would assume they would have no debt or next to no debt. So they're living in big houses, worth a lot. They don't have the income to maintain them. So the obvious thing would be to sell and downsize. But we need to have incentives in place for them to be able to do that.
Okay, let me run another of the recommendations by you. The federal government should support first home buyers by expanding government assistance programs and easing APRA lending criteria just for first home buyers. So this recommendation focuses on demand rather than supply. How sensible is that?
Yeah, I'm not a big fan of this one, because yes, it will just provide more demand into the market. And we've seen time and time again over the last few decades that whenever there's a first home buyer grant or incentive, then all that does is, and because it's usually capped at a particular price value, so all that does is push all the values under that cap up to that cap a lot quicker.
So it often turns out to be a vendor grant rather than a buyer grant.
Yeah.
And another one of the REIA's recommendations is to expand build to rent by supporting institutional investment. Oh, I mean, do you support that idea? And if so, how much of an impact can build to rent have on the affordability and supply problem?
Build to rent, the institutions that are looking to um, build these developments are they're mainly going to be inner city. They can only do it when there's higher volume. So the higher volume unit blocks in the inner city, and then they're not targeting lower income dwellings. So it doesn't help people in the lower incomes. It's more the medium to higher incomes that they'd be targeting, because it makes it worthwhile for them to be able to do that. So it doesn't really do anything for the people struggling out in the burbs who need to travel a long way for work, and who need cheaper, more affordable housing. Can it help provide more supply into the market in overall and in general? Then yes, the answer is yes. But it's not what everyone assumes it is to begin with.
Another recommendation is to preserve investor confidence by maintaining the current negative gearing and capital gains tax exemptions. Owen, do you think the affordability and supply issues would get worse if we eliminated the negative gearing and CGT exemptions?
Definitely on the negative gearing, there's no need to dilute it any further. It already has been diluted since the Labor government of Hawke and Keating brought it in, and it was the Howard government and the Turnbull government that did all of that watering down. So it's a fairly neutral in terms of any incentives. It's short-lived, but it does provide some help for the investor to be able to buy and keep that property in the first 5 years, which is always the biggest risk for the investor. In terms of CGT, if we wanted people to be able to hold on to their properties for longer, to be able to maintain rental supply in the market, yeah, it could be a thing that we pause any CGT exemptions for maybe the next 3 years.
The final recommendation I want to run by you, the REIA suggests that state governments phase out stamp duty to reduce barriers to entry for buyers. Owen, what are your thoughts? Should state governments replace stamp duty with some other revenue raising initiative such as land tax?
Absolutely. This is my pet project idea that I've been banging on about for years. It's stamp duty reform and land tax reform needs to happen to be able to make the property market more liquid, make it easier for people to be able to move. So which is one reason why the whole rent festing phenomenon that has happened in the last 10 years is really taking off more, because people don't want to commit themselves to a property where to be able to get into it and out of it costs them $50, $100, $150, $200,000, depending on the value of the property and where the property is. So so they'd rather just buy something that they know that they can keep for a long term and not have those extra expenses. And just rent where they want to live and be able to easily move. So the idea is that we can either reduce or replace completely stamp duty with some form of land tax on all or at least a majority of properties. There's a number of ways being able to do it. Where we can scale it based on values in the LGA or values at a certain distance away from the CBDs, and it would provide a lot more incentive for people to be able to buy something quicker and buy something because there's a lot of people who don't qualify for first home buyer grants, who have owned property in the past, and for whatever reason they've had to sell it, and go back to renting, but they'd love to buy again, but they're not in a position to. So, this is the perfect example of being able to allow people to be able to do this. So yes, it's worthwhile. But of course, whenever you make major changes to taxes and tax laws, people don't like change to taxes. People automatically think it's going to be negative, and so it's not a popular idea with politicians.
Oh, I think the key thing is something that you touched upon, which is stamp duty can't be removed and replaced with nothing. But state governments need to get all that revenue from somewhere. So it'll
Yeah.
have to be replaced by some other revenue raising initiative.
Yes. And the only obvious one is land tax. And so going back to the earlier one, I think it was the first point you brought up that they've proposed about giving incentives to older people, retirees, to be able to sell their empty nest large houses. This is a perfect example of where if they were in a position where they had to pay a land tax on an ongoing basis, but they couldn't afford it, then there's a incentive there to be able to sell and downsize to a property that of lower value that would probably suit their needs better, that they would be able to afford to uh, uh, maintain on an ongoing basis. And then if because of the lower value, there might be a lot lower, if not zero, land tax, depending on how it's structured. So it's about allowing people who can afford the bigger properties to be able to get into them in terms of ongoing maintenance and upkeep because they have the income, and the people who can't, giving them the incentive to be able to downsize, because there's a lot of retirees who just look at the numbers when they have to downsize and think, wow, I've got to pay the selling costs. But it's not just the selling costs, it's the stamp duty on paying for something that's smaller. And a lot of the times, these smaller properties, because they fit in that sort of medium price bracket and they've been pushed up in value by a lot of first home buyer grants, they don't see the value in downsizing from a price point of view. And as a result, they then have to pay the stamp duty on top. And so the benefits to them financially is negligible in the short term. So they think, well, I'll just stay where I've always been for such a long time, and I'll put that money into renovating the property to make it easier for me to live here. So yes, if we were to change that system, and it would make it easier, make it the property market a lot more fluid in terms of how people can move.
Our final story for today, more homes being listed for sale. A total of 243,642 properties were listed for sale in January, according to SQM research, which was 4.5% higher than the month before and 10.3% higher than the year before. Focusing just on new listings, which are properties that have been on the market for less than 30 days, there were 53,019 new listings in January, which was 2.9% more than the month before and 18.1% more than the year before. SQM Research Managing Director Louis Christopher said, at this stage, it was hard to know whether the spike in listings had been caused by a rise in vendor confidence or an increase in the number of fearful vendors wanting to exit the market. Going forward, the RBA's meeting and interest rate decision on the 18th of February will naturally be the focus for most participants, he said. If an interest rate does occur, we believe this will lift confidence in buyer demand. Oh, and Louis Christopher says he doesn't know if the increase in listings is because vendors are confident or because they're fearful. What are your thoughts?
Probably a bit of both. We've had this sustained higher interest rates than we did 4 years ago, and a lot of people had bought into these properties. And so just that sustained higher interest rates has probably taken its toll on a lot of people. And they're making the decision to sell, while in a lot of areas prices have started to stagnate and flatten off. So they're not seeing the benefit of holding on, because prices are increasing. So that's where we might be looking at some of the confident vendors, where they're saying, all right, we're gonna make a move and put our properties on the market to sell, and take what we can get now, and move on in the same market, to be able to get a property that either better suits us, or at a better price point for us.
As of February the 7th, the market believes there's a 95% chance of a rate cut at the next RBA meeting on February the 18th. If a rate cut does occur, what impact will that have on listing volumes?
I expect listing volumes will go up. It's because people will want to take advantage of the opportunity of more buyers being able to pay more because they can borrow more. And that's probably where some of that increase in supply has happened, because a lot of agents will be telling their vendors, if you want to sell, get on the market now, because as soon as interest rates start to drop, then there'll be a flood of properties on the market, of people looking to take advantage of that. So yes.
There are going to be a lot of people watching that RBA meeting on February the 18th very closely. We've discussed it in the past few weeks. The market is all but certain there will be a rate cut, and yet if you read the RBA commentary from the past 6-12 months, the commentary implies that they're not going to cut. So it'll be very interesting to see what happens.
Yeah, I don't know who they're talking to, because yes, if you just read into what the RBA is saying, there's no indication at all that they're going to drop. So maybe they're willing it. Yes.
Okay. Well, our next podcast will actually be recorded one day before that RBA meeting, and
Yes.
it'll be interesting to see what the mood in the market is like at that stage.
Yes, it's we'll wait with anticipation to see what happens.
Great to chat, Owen, and hope you have a wonderful week.
Thanks, Nick. You too, and we'll see you next week on the weekly news.